The moment everyone else is panic selling, the smartest investors in the world are quietly building generational wealth. And today I'm going to show you exactly how they do it. This is not a motivational video. This is a step-by-step compounding strategy that works specifically when markets are bleeding red. The painful truth most investors never learn. Here is something that will completely change the way you think about money forever. Every single market crash in history, 2008, 2020, the dot-com bubble, the 1987 Black Monday, every single one of them had one thing in common. The people who lost everything were the ones who sold. The people who got filthy rich were the ones who bought more. That sounds simple, right? Almost too simple. But here is the brutal reality. When the market is crashing and your portfolio is down 30%, 40%, even 50%, every emotion inside your brain is screaming at you to get out. Your hands are shaking. You are checking your phone every 5 minutes. You are watching the red numbers pile up and your stomach is turning. This is called panic psychology, and Wall Street banks on it, literally. They count on retail investors like you and me to panic sell our positions at the worst possible moment, so that institutional investors can scoop up those same assets at massive discounts. But what if you had a strategy so mechanical, so disciplined, so mathematically proven that your emotions simply had no power over your decisions? What if instead of fear, you felt excitement every time the market dropped? That strategy exists. It is called structured compounding during volatility, and it has created more millionaires during bear markets than any bull run in history. Stay with me, because what comes next will permanently rewire how you see market crashes. Understanding compounding, the real version. Most people think they understand compounding. They have heard the famous Albert Einstein quote, that compound interest is the eighth wonder of the world. They nod their heads. They say, yes, I know about compounding. But then they completely misapply it in real life, especially during market downturns, and that mistake costs them decades of wealth building. So let me break this down in a way that actually sticks. Compounding is not just about earning interest on interest. At its deepest level, compounding is about buying more units of a growing asset over time, so that every future gain applies to a larger and larger base. That is the real engine. That is what separates people who retire wealthy from people who work until they are 70. Here is a simple example. Imagine you own 100 shares of a solid index fund today. Each share is worth $50. Your total investment is $5,000. Now the market crashes. That same share drops to $30. Most people cry. Smart investors smile, because now their next $5,000 buys not 100 shares, but 166 shares. They just increased their ownership by 66% with the exact same amount of money. Now fast forward 5 years. The market recovers, and that share is worth $80. The panic seller who held 100 shares made $3,000 profit. The smart buyer who accumulated 266 shares made $7,980 profit on the same original capital. That is not luck. That is not timing the market. That is structured compounding during a crash, working exactly as designed. And here is what makes this truly explosive. We have not even introduced the reinvestment layer yet. When you combine accumulation during crashes with automatic dividend reinvestment and consistent monthly contributions, the numbers stop looking real. They start looking like something only the ultra-wealthy experience. But they are available to anyone who follows the system correctly. Why market crashes are actually scheduled sales. Let me give you a mindset shift that will permanently change your relationship with market crashes. Imagine your favorite store, the one you love shopping at. Now imagine that store suddenly announced a massive sale. Everything is 40% off, 50% off. Some items even 60% off. What would you do? You would rush in and buy as much as you possibly could before the sale ended, right? That is exactly what a market crash is. It is a sale on wealth-building assets. The companies do not disappear. Apple does not stop selling iPhones. Amazon does not stop delivering packages. Microsoft does not stop running cloud servers. These businesses keep operating, keep generating revenue, keep growing. But their stock prices are temporarily discounted because of mass panic, fear, and emotional selling. Warren Buffett did not become the second richest man in the world by avoiding crashes. He became wealthy by treating every single crash as the greatest shopping opportunity of his lifetime. During the 2008 financial crisis, While banks were collapsing and news channels were predicting the end of capitalism, Buffett deployed billions of dollars into undervalued companies. He later called that period one of the most exciting investing environments he had ever seen. But here is the problem most regular investors face. They do not have billions sitting in cash waiting for a crash. They are living paycheck to paycheck, trying to invest small amounts consistently. Does the compounding crash strategy still work for them? Absolutely yes. And in many ways it works even better for small investors because of something called dollar cost averaging on steroids. We will get deep into the mechanics very soon. But first you need to understand the three types of investors that exist in every single market crash. Because knowing which type you are right now is the first step to changing everything. The three types of investors in every market crash. Every time the market crashes, without exception, investors split into three distinct groups. Understanding these three groups is critical because your natural instinct will push you toward the wrong one every single time unless you consciously choose otherwise. The first group is the panic sellers. These are the majority, roughly 70% of retail investors. The moment their portfolio drops 20% or more, they sell everything. They tell themselves they are being smart. They say they will wait for the bottom and buy back in. But here is the brutal truth. Nobody catches the exact bottom. By the time panic sellers feel confident enough to re-enter the market, prices have already recovered 30% to 50%. They locked in their losses and missed the entire recovery. This group does not just lose money during crashes. They lose years of compounding growth that can never be recovered. The second group is the frozen investors. These are people who do nothing. They are too scared to sell, but also too paralyzed to buy more. They simply watch and wait. While this is better than panic selling, it is still a massive missed opportunity. Frozen investors survive crashes, but they never truly capitalize on them. They end up with the same number of shares they started with, missing the single greatest wealth-building window the market offers. The third group, the smallest group, maybe 10% of investors, are the strategic accumulators. These are the people who have a written plan before the crash ever happens. When the market drops, they do not check their emotions. They check their strategy document. They know exactly how much to buy, when to buy it, and which assets to target. They are not guessing. They are not hoping. They are executing a system that was designed specifically for this moment. By the end of this video, you will have everything you need to become a strategic accumulator. With a clear, actionable framework you can start implementing before the next crash arrives. The compounding crash strategy, building your foundation. Now we get into the actual mechanics. This is the part most finance channels skip because they want to keep you coming back for more videos. I am giving you the complete system right here, right now. Pay close attention because every single piece of this framework connects to the next. The compounding crash strategy is built on 4 foundational pillars. Miss even one pillar and the entire structure weakens. Master all 4 and you have a wealth-building machine that literally gets more powerful the worse the market gets. Pillar 1 is your emergency fund firewall. Before you invest a single dollar into any market crash strategy, you must have 3 to 6 months of living expenses sitting in a high-yield savings account completely untouched. This is non-negotiable. Here is why. If a market crash coincides with a job loss, a medical emergency, or any unexpected expense, and you do not have this firewall in place, you will be forced to sell your investments at the worst possible time just to cover your basic needs. You become a panic seller not by choice, but by necessity. Your emergency fund is what gives you the psychological and financial freedom to buy aggressively when everyone else is selling desperately. Pillar 2 is your crash capital reserve. This is separate from your emergency fund. This is money you set aside specifically and only to deploy during market downturns. Financial experts recommend keeping 10% to 20% of your total investable assets in cash or cash equivalents at all times specifically for this purpose. Think of it as loaded ammunition waiting for the right moment. Most people are fully invested all the time and have nothing left to deploy when the best buying opportunities appear. Strategic accumulators always keep powder dry. Pillar 3 is your pre-selected asset list. You do not decide what to buy during a crash. You decide before the crash ever happens. Emotions are too high, news is too loud, and panic is too contagious during a downturn to make clear, rational decisions in real time. Your pre-selected asset list contains the exact funds, ETFs, or stocks you will buy when prices drop to specific levels. We will cover exactly how to build this list in the next section. Pillar 4 is your trigger system. This defines precisely when you deploy your crash capital, not based on feelings, not based on news headlines, based on specific percentage drops that you define in advance. For example, deploy 25% of crash capital when market drops 15%. Deploy another 25% when it drops 25%. Deploy remaining 50% when it drops 35% or more. This mechanical trigger system removes emotion completely from your decision-making process. Building your PRE-selected asset list. What to buy during a crash. This is where most beginner investors make a catastrophic mistake. When the market crashes, they start buying random beaten-down stocks because they look cheap. A stock that dropped from $100 to $20 feels like a bargain. But cheap and valuable are two completely different things. Many stocks drop 80% and never recover. Some companies go bankrupt during recessions. Buying the wrong assets during a crash does not just fail to make you rich, it permanently destroys your capital. So what should you actually buy? Let me break this down into 3 tiers based on risk tolerance and investment timeline. Tier 1 is for everyone regardless of experience level: broad market index funds and ETFs. These include instruments like the S&P 500 index funds, total market ETFs, and global index funds. When you buy a broad market index fund, you are not betting on one company. You are buying a small piece of the entire economy. Historically, the S&P 500 has recovered from every single crash in its history and gone on to reach new all-time highs. Every single time without exception. Buying more of these during a crash is as close to a mathematical certainty of future profit as investing gets. Tier 2 is for investors with moderate experience, dividend aristocrats. These are companies that have increased their dividend payments for 25 consecutive years or more. Companies like Johnson & Johnson, Procter & Gamble, Coca-Cola. These businesses have survived world wars, Great Depressions, financial crises, and global pandemics. During a crash, their stock prices drop, but their dividends often remain stable or even increase. This means you are buying a cash-generating machine at a massive discount. And here is the compounding magic. When you reinvest those dividends to buy more shares at crash prices, you are multiplying your future income stream exponentially. Tier 3 is for experienced investors only, sector-specific opportunities. Certain sectors get disproportionately crushed during specific types of crashes. During the 2020 pandemic crash, travel and hospitality stocks dropped 70% to 80%. Investors who recognized this as temporary bought aggressively and saw 300% to 500% returns within 2 years. But this tier requires deep research, strong risk tolerance, and a clear understanding that individual sector bets can go permanently wrong. Only allocate a small portion of your crash capital here, never more than 20% of your total deployment budget. The rule across all 3 tiers is identical. You buy what you already researched and pre-approved before the crash. No impulse decisions. No chasing hot tips from social media. No emotional reactions to daily price movements. Your pre-selected list is your Bible during a market downturn, and you stick to it with absolute discipline. The dollar cost averaging supercharge, turning small money into massive wealth. Here is where the strategy gets genuinely exciting. Everything we have covered so far, the 4 pillars, the asset tiers, the trigger system, all of it becomes exponentially more powerful when you layer dollar cost averaging on top of it. And the beautiful thing about dollar cost averaging, or DCA, is that it works perfectly for people who do not have large lump sums to invest. In fact, small, consistent investors often outperform lump sum investors over long periods when they apply DCA correctly during market crashes. Let me explain exactly how this works. Dollar cost averaging means investing a fixed amount of money at regular intervals regardless of what the market is doing. Every week or every month you invest the same dollar amount. When prices are high, your fixed amount buys fewer shares. When prices are low, your fixed amount buys more shares. Over time, your average cost per share becomes lower than the average market price, automatically, mathematically, without any guesswork required. Now here is where most people stop. They set up a basic DCA plan and invest the same amount every single month, whether the market is up or down. That is good. That is better than nothing. But strategic accumulators take this one step further with what I call crash-accelerated DCA. The concept is simple but devastatingly effective. You maintain your regular monthly investment amount as your baseline. But when the market drops beyond your predetermined trigger points, you temporarily increase your monthly contribution by a specific multiplier. Here is a practical example. Let us say your regular monthly investment is $300. That is your baseline. Now you set up 3 acceleration levels. When the market drops 10% from its peak, you increase your monthly contribution to $450. That is 1.5 times your baseline. When the market drops 20%, you increase to $600, double your baseline. When the market drops 30% or more, you go to $900, 3 times your baseline. You maintain these elevated contributions for as long as the market stays at those depressed levels. The moment the market recovers above your trigger threshold, you return to your baseline of $300. What does this do to your long-term returns? The difference is staggering. A person investing flat $300 every month for 20 years in an S&P 500 index fund, assuming historical average returns, ends up with approximately $270,000. A person using crash-accelerated DCA with the same average monthly contribution over the same 20 years ends up with significantly more because they systematically accumulated more shares during every single bear market and correction. Those extra shares compound for years and decades after the crash ends, multiplying the impact of every single discounted purchase they made. The key requirement for this strategy is having the cash available to increase contributions during downturns. This brings us back to Pillar 2, your crash capital reserve. This reserve is not just for lump sum deployment. It is also your funding source for accelerated DCA contributions during extended bear markets. Every dollar sitting in that reserve is a soldier waiting to be deployed at exactly the right moment for maximum compounding impact. The reinvestment loop, the most powerful wealth multiplier most people ignore. We have talked about buying more during crashes. We have talked about accelerating your contributions. Now I want to show you the third engine of this strategy, the one that works silently in the background, requires zero additional money from you, and yet accounts for an absolutely massive portion of long-term wealth creation. This engine is called the Dividend Reinvestment Loop, and understanding it fully will change how you think about passive income forever. Here is the core concept. Many stocks and index funds pay dividends, regular cash payments made to shareholders simply for owning the asset. Most beginner investors treat dividends as a bonus. They receive the cash payment and either spend it or let it sit in their brokerage account doing nothing. This is a devastating waste of compounding potential, especially during market crashes when dividend reinvestment is at its most powerful. When you enroll in an automatic dividend reinvestment plan, known as a DRIP, every dividend payment you receive is automatically used to purchase additional shares of the same asset. No action required from you. No decision-making needed. The system runs itself. Now here is why this becomes explosive during a market crash specifically. When share prices are depressed, your dividend payments buy significantly more shares than they would at normal market prices. More shares mean larger future dividend payments. Larger dividend payments buy even more shares. Those additional shares generate their own dividends, which buy even more shares. This is a self-reinforcing loop that accelerates the longer it runs. Let me put real numbers to this so you can feel the actual impact. Imagine you own 500 shares of a dividend-paying index fund. Normal price is $60 per share. The fund pays a 2% annual dividend. That is $1.20 per share per year, or $600 total annually for your 500 shares. Now the market crashes and the price drops to $36 per share, a 40% decline. Your $600 annual dividend now buys not 10 shares at normal price, but 16.6 shares at crashed price. You just received 66% more shares for the exact same dividend payment. Those extra 6.6 shares will generate their own dividends forever. They will compound for the next 20, 30, 40 years. A market crash just gave you a permanent 66% boost to your dividend compounding engine at zero additional cost. Now multiply this across multiple dividend positions, across multiple crash events over a 25-year investing career. and you begin to understand why long-term dividend reinvestors consistently end up with portfolios 3 to 4 times larger than investors who took their dividends as cash. The reinvestment loop is not exciting. It does not make headlines. Nobody posts about it on social media. But quietly, relentlessly, mathematically, it builds wealth on a scale that almost nothing else can match. The practical action step here is simple. Log into your brokerage account today, not tomorrow, not next week, today, and enable automatic dividend reinvestment on every single position you hold. This 5-minute action could add hundreds of thousands of dollars to your final portfolio value over a long investing career. And during the next market crash, while everyone else is panicking about falling prices, your DRIP will be silently purchasing additional shares at maximum discount, turbocharging your compounding engine precisely when it matters most. The psychology of staying in, controlling your biggest enemy. Every strategy we have discussed so far is completely useless if you cannot control one thing: your own mind. The biggest threat to your wealth during a market crash is not the crash itself. It is your emotional response to it. Studies from behavioral finance consistently show that the average retail investor earns significantly less than the market average return, not because they picked bad stocks, but because they bought and sold at emotionally driven moments. When markets crash, your brain triggers the same fear response as physical danger. Cortisol floods your system. Your thinking becomes short-term and survival-focused. Every news headline feels catastrophic. Every red number feels permanent. In this state, selling feels like relief and holding feels like suffering. But this emotional discomfort is precisely the price of admission for long-term wealth building. The most effective tool against panic is a written investment policy statement. This is a one-page personal document you write during calm market conditions that defines your strategy, your triggers, your asset allocation, and most importantly, your commitment to stay the course during downturns. When markets crash and emotions spike, you read this document instead of watching financial news. It becomes your rational voice when your emotional brain goes into overdrive. Successful investors do not have less fear than average investors. They simply have better systems for preventing fear from driving their decisions. Your written plan, your pre-selected asset list, your mechanical trigger system. These are not just financial tools. They are psychological armor that protects your wealth from your own worst impulses during the most critical moments of your investing journey. Real-world examples. How this strategy performed in actual crashes. Theory is powerful, but real-world proof is what truly builds conviction. So let us look at exactly how the compounding crash strategy performed during 3 of the most devastating market crashes in recent history, because the numbers tell a story that no amount of motivation ever could. During the 2008 financial crisis, the S&P 500 dropped approximately 57% from peak to bottom. Investors who panicked sold at the bottom locked in catastrophic losses. But investors who continued their regular DCA contributions throughout 2008 and 2009 and deployed additional crash capital at the trigger points we discussed saw their portfolios recover fully by 2012 and reach new all-time highs by 2013. The crash that destroyed millions of retirement accounts actually accelerated the wealth building of strategic accumulators. The 2020 COVID crash was even more dramatic in its speed. Markets dropped 34% in just 33 days, the fastest crash in stock market history. Investors who followed the crash-accelerated DCA approach and deployed reserves during March 2020 saw those positions double and in some cases triple within 18 months. The entire crash and recovery cycle happened so fast that patient investors were rewarded almost immediately for their discipline. The pattern across every single historical crash is identical. Sharp drop, mass panic, maximum fear, strategic accumulation opportunity, eventual recovery, new all-time highs. The timeline varies, but the pattern never does. Understanding this pattern intellectually is step 1. Building a mechanical system that forces you to act on it regardless of emotions is what separates people who read about wealth from people who actually build it. Your 30-day crash preparation plan. Do this before the next crash. The biggest mistake investors make is waiting until a crash happens to prepare for it. By then it is already too late. Emotions are running high, prices are moving fast, and every decision feels urgent and terrifying. The entire compounding crash strategy only works when it is built during calm markets and executed during chaotic ones. So here is your exact 30-day preparation plan starting today. Week 1 is about assessment. Calculate your current emergency fund and determine if it covers 3 to 6 months of expenses. If it does not, pause all non-essential investing and build this firewall first. Simultaneously review your current portfolio and identify which positions you would want to buy more of during a crash. These become the foundation of your pre-selected asset list. Week 2 is about building your crash capital reserve. Look at your current investable assets and set aside 10% to 15% in a high-yield savings account labeled specifically as crash capital. Do not touch this money for any other purpose. This single action immediately transforms you from a frozen investor into a strategic accumulator waiting for the right moment. Week 3 and 4 are about writing your investment policy statement. Define your trigger levels, the specific percentage market drops that will activate each phase of your deployment plan. Write down your asset list, your contribution acceleration multipliers, and your commitment to stay the course. Sign it. Date it. Store it somewhere you will actually read it when fear takes over. This document is worth more than any hot stock tip you will ever receive. The compounding mindset. Why this changes everything long term. Everything we have covered in this video comes down to one fundamental truth. Wealth is not built during bull markets. Wealth is built during bear markets by the people disciplined enough to keep buying when the whole world is selling. The compounding crash strategy is not complicated. It is not reserved for Wall Street professionals or people with millions of dollars. It is available to any person willing to prepare in advance and execute with discipline when the moment arrives. The most important shift you need to make is redefining what a market crash means to you personally. From this point forward, a crash is not a disaster. It is not a threat. It is a scheduled, predictable, mathematically guaranteed transfer of wealth from emotional investors to prepared ones. Every crash in history has ended. Every recovery has created new millionaires. The only question is which side of that transfer you will be on next time. Start small if you need to. A $50 monthly investment using crash-accelerated DCA with automatic dividend reinvestment, maintained consistently for 25 to 30 years, can produce results that feel completely impossible right now. The math of compounding does not care about your income level, your education, or your background. It only cares about consistency, patience, and the discipline to buy more when everything feels most terrifying. If this video changed the way you think about market crashes and compounding, share it with one person who needs to hear this message. Subscribe for more strategies that cut through the noise and give you real actionable systems for building lasting wealth. The next crash is coming. Nobody knows exactly when, but it is coming, and now you are ready for it.